Hello everyone, my name's Kyle, and this will be the second video installment in the YouTube series about Islamic finance. And today we'll be talking about Riba and Gharar, which are different ideas or principles that are used in Islamic finance. So when most people define Islamic finance, they say that Islamic finance is interest-free banking, which is relatively reductionist because they still do charge it. It's just not one of the pillars or cornerstones of how they practice. So the first topic that we're going to talk about is riba, which when translated to English loosely means interest. And then the second topic is gharar. Sorry I'm not pronouncing it right. I was not born speaking Arabic, but if you were to pronounce it with an English dialect, that's how it is. It's Gharar. And that loosely means risk avoidance. So I'm going to flesh these two out today. So riba was first mentioned in the Quran by Muhammad, and it was mentioned two more times in the Hadith by his companions. Generic riba that was first mentioned in the Quran literally means to increase, but it's a bit more than that. So actually, riba refers to the unlawful and undeserved gain from a quantitative increase. So someone getting something at the expense of another is what riba is against. So this basically means interest or essentially loan sharking in one form, while another under the classical term of riba would be charging late fees. So these are things that Islamic finance is designed not to do. However, modern banking does have interest, and unless the whole world decided to reconstruct itself on the Islamic pattern, it would be suicidal for a country and the financial system to abolish interest. That being said, riba does address the inflammatory nature of an interest-backed economy. So scholars say that riba has three major misunderstood qualities to it. The first one would be the Quranic riba refers to a system of doubling interest at the end of the loan. So if you have 90 days to pay back your loan and they charge you interest, and at the end of the 90 days you can only pay back the basis of the loan, the money that was lent, not the interest, what would happen at the time of Muhammad is they would double the interest that you have, and the system would keep going on. And if by the end of the time the interest is doubled, it would get doubled again until the point where the borrower defaults and then becomes enslaved by the bank. Now, the second misunderstanding with riba is that it's based on a verse from the Hadith in the part that's from his companions, where it outlines 6 different commodities that can't have interest, and none of them specifically are money. So that is important to keep in mind. And the third misunderstanding about riba is that it's primarily outlined against loans with usury, which is considered an incredibly high interest. So classical Islamic finance actually allows interest on business loans, but it's disallowed amongst payday advances, which are very common in the US, which charge a very high interest rate to try to get your paycheck before it comes out. Now, the second concept in Islamic finance is going to be gharar, which is considered risk avoidance, or it's relatively close. It's actually a multifaceted concept. So, Qadi Iyad, I believe that's how you pronounce it, was an 11th century scholar, and it defined gharar as that which has a pleasant appearance but a hated essence. So, most modern translations see gharar as the risk arising from parties having a lack of knowledge about each other. So that's called asymmetrical information. A common example of asymmetrical information is the start of the medical marijuana industry, where people could go and come up with relatively loose diagnoses that are hard to prove or disprove, and then be given the card, because that was the system that they had. And the doctor doesn't know you're lying in this sense. So now this concept is supposed to be applied to banks where, they have things in the fine print and people don't actually know what's going on. Now the second modern translation of gharar would be an object that does not now exist. So Islamic finance does not like paying for futures on things that exist. So if you're saying, hey, I want a loan to produce this, classical Islamic finance does not agree with this concept, because how can you know what's going to happen? Things can change. You might make less, you might make too much, which could end up changing the operating cost of it. So Islamic finance does not like working with uncertainty. And then the third Modern translation would be that an object is being financed that's outside of everyone's control. So if you're making something and you don't know if it's going to actually pan out, because say for example you're making a bunch of pottery and you put it in the kiln, and the way you're making them, some of them are subject to break but not all of them. Islamic finance does not like supporting these types of things because there's no certainty as to whether it's going to actually work out properly. So it's between these two ideas or principles that are usually the reasons why Islamic banks are less affected by financial markets with bubbles that burst. Thank you.